Happy Friday, everybody. This is Jonathan Tran from PARAMIC Financial. I have here today, Alex is back.
Hey everybody, good to be back. It's been a while since I've been on the live stream. I've been doing the back shop for us lately, but it's good to be back, and hope you guys are excited for us to all be together again.
Yes, and then we have Frank here.
Hey everyone, this is Frank again. I've been on every live stream so far, but glad to be here again.
Yeah, we took a little bit of time off because of the 4th of July and then some, personal things that we need to take care of for business. Got a little bit busy, so we missed live stream for the last 2 weeks, but we're back today, and so we hope you guys are having a happy Friday. Our topic today is going to be, where are you investing your money? Because lately we've been talking a lot about different financial topics. We've been talking about insurance. We've been talking about saving money in retirement. We've been talking about life insurance. But then the topic of, where can you really invest your money? We haven't really addressed that. Now, of course, we're not really going to, give any specific advice for anybody because we're not allowed to do that on stream. But we'll just give you guys some hypotheticals, some general education so that you know where we can put money when it comes to investing your money, right? So, but before we get started, let me see here. Oh, hello, Kotan. Happy Friday, Call. Thank you for joining. You're always a big supporter of us. If you guys help us share the stream, tag any friends that may benefit from this information. We always try to bring new content to you guys. There's some news and some information in regards to our topic and also some news that's there. We do it, this stream, every Friday around 1 or 2 o'clock in English. And then on Monday, we do it in Vietnamese around the same time as well. Okay, if you guys want to follow us more in terms of pre-recorded content, go to our YouTube channel, the PARAMIC Financial Services YouTube channel. And we have a lot of different videos on there. I think we're probably going to be up to like 56 videos of different types of financial topics, solutions, services, whatnot that we can help in the office. And so go to our YouTube channel, check it out, subscribe and like our page there. That way you can keep updated with all the new things that are happening. But before we get started, let's do a little bit of news. So let's see here. Alex, since you've been gone for a while, why don't you start out with some financial news in terms of like the stock market?
All right. Well, as you guys usually know, I usually start off with some of the numbers with the stock market, what it looks like. Unfortunately, today it's not looking good. From early this morning, from 10 o'clock, all the numbers were pretty decent, but after around 1 p.m.-ish, 12, it went down a lot. So the Dow Jones from 10 all the way until about 12 went down 159 points, which is not very good, about 0.49%. The NASDAQ went down 51.79 points. It's about the same, about 0.5%. S&P 500 went down 15.97 points, so not looking really good. Not much of a huge recovery. Some other news I have for you guys here. Consumer prices have increased 5.4% in June from earlier this last year. It's the biggest monthly. It's the biggest monthly change since last August 2008. Okay. Excluding food and energy, inflation has increased by 4.5%, which is the largest since September 1999. Okay. Moving on, there was some news about some local banks shutting down all existing personal lines of credit in the coming next few weeks. They will no longer be offering these products. The personal statement said, in effort to simplify our products, we are eliminating these loans. The banks can better meet the borrowers' needs to our customers through credit cards and personal loans. So keep that in mind. There's some news about when these things close, it may and can affect your credit depending on how much you owe. So definitely take a look at that. Consult the bank that you have if this is within what's happening with you, so you definitely can protect yourself and preserve your credit. And that's it. That's really it for today that I have for the news.
Thank you, Alex. So it looks like, just like the weather outside right now, it looks like it's kind of raining and cloudy, looking bad weather, and the stock market's not doing too good today. But hey, the market's always up and down, right? But still, trillions of dollars are still going into the stock market, right?
Yes.
Despite the fact that we may have good days and bad days. Okay, so Frank, do you have any news for us today?
Yeah, sure. It's just the same news as always, right? Just want to remind the people one more time that the deadline to enroll in health insurance is once again August 15th. We're midway July now, so I think we have exactly a month to go. So if you haven't already to enroll in a health insurance plan through the marketplace, just give us a call or text us or email us, and then we will do our best to help you. If you already have a plan somewhere or with us, but you're not happy with the service for some reason, maybe the cost is too high, or maybe you don't have enough coverage, please give me a call or text me too, so I can help you. So that's my news for today. And again, deadline for health insurance, the marketplace is August 15th.
Wow, so only one more month left, everybody, that you can make a change to your health insurance if you bought it through the marketplace. So there's still a chance for you to make some changes so that you could save some money or change a plan if you want a different doctor or you want better coverage. So yeah, give us a call at our number below if you guys need help with that, and we definitely be able to, love to help you with that. Right? Otherwise, you have to wait until November-ish, December, to enroll for 2022, right? So the year is coming, almost to an end already. We're already past the halfway point, right? So, try to get things taken care of before the year ends. Okay, Frank. So for myself, tax-wise, everybody's been waiting for the big drop if you have children. If you have children and you may qualify to receive some extra stimulus payments, $3,600 total, up to $600 a month until the end of the year. Now, if the IRS doesn't know about your children, there is a new link on the IRS website, which I will post below, where you can go to the IRS website and you can claim your child credit deduction credit ahead of time. So if you don't want to wait until 2022 to file your tax and get the big check, then you can go to the IRS website, complete your information. Maybe you just had a baby this year and now you want to claim those credits. Now you can go into the website and claim those credits, right? So for those of you who really need that money right now, and you don't want to wait until the end of the year for the IRS to give you the big check, then you can go to the website and then you can apply, and then they will, you give them your information, your children's information, social, all that good stuff, and then you give them your bank account information so they can direct deposit the funds into your account, right? There is a phase out, so if you are single, it's about $75,000. If you're married, $150,000 income. So if you make too much money, you may not receive the full amount. So just keep that in mind, but it is for those people who not have high income, so that you can get some extra money to support your family. So that's my news for today. Pretty exciting. It's supposed to start dropping yesterday, and going forward. So keep an eye on your bank account and see if you got money. If you don't, check out that link that I sent below. Okay. So that's pretty much it for news today. So go on to our topic. So where are you investing your money right now? That's a big question. There's so many places that we can save our money, right? Traditionally, when people think of saving money, it's already hard, right? Most people traditionally, what they do is they spend all their money first, and then they attempt to save afterwards. But the problem with that is most of the time, if you wait until after you spend all your money, well, your money's already all gone, there's nothing left to save, right? So that's why a lot of people who work for corporate and they have a 401k, which is a retirement account, they take that money out of their paycheck first before the money actually hits their bank account. So in a sense, they are saving their money a little bit better because it's coming out of their paycheck before they receive it, right? So most people that wait till they get the paycheck, well, probably most likely, unless you have a lot of extra discretionary income, most of your money is either going to go to bills, or it's going to go to your fun stuff, or whatever you're going to spend money on, boba drinks, Frank. Then it is going to be all gone, right? Go eat, go hang out, and the money is going to be all gone. So, but where are people investing their money? Traditionally, when people think about saving money or putting their money somewhere, what's the first place, Alex, you think of?
Probably the bank.
The the bank, yeah.
Savings account.
Why do people put money in the bank, Alex?
They put money in the bank because they feel it's safe. That's where they already have their money, and they feel that when the bank tells them that they're already holding your money, then if you open a savings account, then we can help you earn some interest, which the interest is barely non-existent.
Right.
But that's the traditional way that people are used to. It's a very user-friendly, easy way. You don't really have to learn or understand anything about it.
Right. So the first place people put money in is the bank, right? And you should put some money in the bank. Why? Because you got to pay bills, right? You should put some extra money in savings. So in the case that you need money accessible right away, you can have it, right? Savings in the bank provides you a guaranteed FDIC insurance up to a certain amount depending on how many people are on the account. So you have that additional protection guarantee from the bank that, hey, you keep your money with me, I'm going to keep it safe for you. But in return, you don't get much interest, right? If you understand the rule of 72, with Albert Einstein, he thought of this rule. If you take 72 and you divide it by the interest that you're receiving, it tells you how many years it takes for you to double your money. So if you're getting, I don't even think the bank gives you 1% right now, but let's just say the bank gave you 1%, you take 72 divided by 1, it takes you 72 years for you to double your money. By then, we'll probably be dead, right, before we can even double our money. So that's if 1% interest. Now imagine if the bank's giving you 0.1%, well then you can times that by 10, by 10, and it'll take you 720 years to double your money. You'll be dead 7 times over before you can even make any interest, right? So essentially putting money in the bank, you're not going to make any money at all, but it's a simple way to put money in there, and it's not very complicated. You just put it there, and it's there when you need it, right?
Yes.
Now, trillions and trillions of dollars are in the bank accounts. Even locally here, the bank right across the street right here, the Chase Bank, Wells Fargo Bank, collectively each bank is holding their deposits. I don't think they keep it in their bank vaults, but their deposits that their clients open their accounts there are holding like $150 million or more of money just in those bank accounts. Imagine $150 million sitting there, not making any interest at all. And the bank's making all the interest, right? They take your money, they lend it out to other people, and that's where the bank's investing, right? The bank's investing, by lending out money, and they're making interest that way. But of course, the general investor, unless you're doing some private lending program, you don't have access to do that type of investment, right? So we're going to talk about more of the general ones that we have readily accessible to. So that's with one side. Another side is people put money into the stock market, right? Why do people put money in the stock market, Frank?
I think for me, people put the money into the stock market, one is because it has the potential to generate more interest rate in the long run. Or if they want like some cash in the short run, stock market is pretty much ideal, but I think it has more risks.
Yeah. What do you mean by risks?
As you heard the news that we spoke about earlier, like from Alex, he said that the stock market is not looking good today. The points are down, so you have the potential to gain more. To get more money, but at the same time you have the potential to lose your money.
Right.
So there's there are pros and cons when you put money into the stock market, but that would be my go-to if I think about saving besides putting my money into the savings account.
So Frank is right. Trillions of dollars goes into the stock market, and people know that I could either make it big or I could lose it all. But people still put their money in, right? Because they believe that whatever companies that they're investing in or that they're buying stocks, bonds, options in, that it's going to make them money, right? And honestly, I think people put money into the stock market because you make money, you got to work for it.
True.
Right? So it's quote unquote easy because you just throw the money in there, and if it grows, you made money and you didn't have to work for it. Right? So a lot of people are attracted to the idea of making money and not having to work for it. But at the same time, it's kind of like almost gambling if you don't really know what you're doing, and there's no guarantees anyways, even if you know what you're doing, that you could lose your shirt if you put your money in the market. And so a little bit later, Alex is going to talk a little bit more about some key terminologies around, hey, if I wanted to invest money into the stock market, what are some key items I need to understand? And Alex has prepared some stuff for that, so that way we can talk more about that. Okay, so the third primary place that people put money into, and some people don't think about this, is insurance. Right? People think, what do you mean insurance? When I buy insurance, I'm trying to protect against loss, right? What do you mean I can invest money into insurance? So, there are some products like life insurance with cash value that you could, you are buying life insurance, but if you structure it properly, it could be an alternate investment vehicle for you to save your money in that can provide you some nice tax benefits and tax advantages. So that's one way, and Frank has prepared some information today about, hey, what if I want to look into investing into some life insurance, buying life insurance, but also have the potential for growth? What does that look like? Yes. Insurance also has some products called annuities, where they can provide you some guarantees. Now, some people may not agree to annuities and may say, why do I have to pay these fees and costs? Or why do I have to lock up my money for X number of years? Well, it's because you want something more than just, hey, I put my money in the market, and if the money goes up, it goes up. If it goes down, I may lose money. Some people cannot stomach that, and they need more guarantees, right? They may want something that say that, hey, you know what? If the market takes a loss, the company will guarantee against a certain number of loss for you. That's pretty interesting, right? Hey, how can I put money in the stock market, but they don't guarantee me against loss? But if I put money in insurance, that they could guarantee me up to a portion of some loss. Sometimes they can guarantee no losses at all, depending on this product that you choose, right? So there are so many different products out there and solutions out there. So you got to understand a little bit about how each one works. In a general concept, so that way you kind of know, like, hey, during my situation, at my time frame of investing, how long I can invest for, what kind of money am I investing, is appropriate for my situation, right? Not everybody's situation is going to be completely the same, and so that's why it's very important to sit down with your agent, with your advisor, with your planner, your tax person, to make sure that we understand what your situation is, what your cash flows are like, what your budgeting is right, and then we look into see, hey, what are you currently doing now, and what are your goals, and is what you're doing now on track to reach your goals? And if it's not, how can you make adjustments to make it better, or how can you diversify so that you're not taking on too much risk, right? So understanding the different places to invest your money is very important. Hello, Kenny. How are you? I hope California is doing well. I hope your family's doing well. Congratulations on your growing family. I hope you guys are doing safe over there in California. I tried to get my in-laws to come to California to visit your dad and your mom, but I think they're not ready since with the COVID and everything. But we hope to see you guys sometime soon. Thanks for joining us today. But going back to our topic, other ways we can invest our money, right? So those are the primary three ways that most people do. Now, other people in the audience may say, well, Jonathan, real estate right now is super hot. Yes, real estate is another way people can invest their money. Alex, you have a lot of customers that are into real estate right now, yes, right? I mean, they're just doing deals left and right. Like you said, one of your customers is doing a new one like every 2 weeks or so?
Yeah, about every 2 weeks, every month. But the competition, you got to remember, the competition within the housing market is really expensive. Everybody's trying to get in on it. So one house, I had one of my real estate friends said that one of the houses, they had like over 30-something different people bidding on it. So the competition is rough. So you got to be really aggressive. You got to get out there, know what you want, have a game plan. But it's an influx market now. So
supply and demand is really, really, real estate is hot right now. But it sounds like the inventory is just not there for people to sell. So even though you can make money, but you're competing against 30 other people on the house, it's crazy.
And Frank, and for housing, it's actually gone up too. We were actually having a customer that was looking to rent within a specific budget. And that budget actually used to be something that was realistic in Texas, but now a house for one family, single family houses are about $16 to $1,700 a month now.
Wow.
At least.
Yeah, at least. So even though housing has gone up, the houses, even rent has gone up too. So it goes pair in pair with each other.
No wonder people are all telling me that I'm gonna go buy a house to rent out for rental rental income. Man.
You know, I got some people tell me that house is going up right now, and most likely they're not going to go down. So the cost of housing or even renting apartments, all the costs that have been going up, they are likely to stay up there from now on. So the best that people can do right now is maybe get used to it.
Yeah.
Wow. Well, I wish I still stayed at home with my parents. I'll save a lot of money. But I'm glad I bought the house back in 13 when the housing bubble popped. And I got the house for $170,000. And I got this guy, he came by my house. He's like, you want to sell your house? I'll sell to you. You can sell to me for $300,000. I'm like,
Wow.
what? It's like $300,000. I bought it for $170,000. Now it almost doubled. But, you know, it's crazy. I think, I don't know what other parts of the states. I hear that Florida is experiencing a lot of influctuation in pricing in terms of house buying. People, even with cash, it's just hard to buy houses. Houses are being overbidded. So those of you, my friends that are in real estate, good luck to you guys. I hope that you make a lot of money while you can. But at the same time, I hope you can close all your deals you want, because it sounds like it's not as easy as some people would think it would be, especially with the market being like that. But no matter what, even the housing market, it has its ups and its downs too, right? It doesn't mean that it's always going to be stable all the time, right? Because investments are investments; they have risks, right? And you invest into a home, you have a risk of you have to keep up with the home. You have to do repairs for the home. You got to find good tenants for the home. You have to maintain it. The housing market could be up and down. Interest rates on your loans. There's a lot of factors involved. Taxes you have to pay. Insurance. Man, I hear you guys dealing with insurance. It's kind of crazy right now, right?
It is.
Yeah.
How much is like
Home insurance go up by 25%
25%?
in the last couple months.
Yeah, even flood insurance has gone up on average 10% already this year too. So people who are paying an average premium of $400 whatnot, it's actually up to the high 500s now.
Wow.
And I remember when I first started working in this agency, I was seeing flood policies for maybe the high 300s, and those policies that continue to renew until this year, they're about 500 now. So it's
Especially in Texas, it's a strange state, man. I got some customer asking me that, hey, I should move from California to Texas, even though the cost of housing is not as expensive compared to California, but the cost of insurance is way more in California. It's because it's different from state to state is the first thing, and then Texas is like a state of, we're in a storm season right now, and because of what has been happening the last couple of years, Harvey and the storm back in February,
ice storm.
the cost of insurance for both home, auto, and everything else is just like fluctuating right now.
Well, as we know, insurance is a transfer of risk. So the higher the risk, the higher the premium, the higher chances of something happening. That you're going to pay more for it. It's just how it works.
Yeah, they in California where I'm from, Kenny, if you're still here, people worry about earthquakes, right?
Yeah.
And fires. But in Texas, we don't worry about earthquakes or fires very much. We worry about windstorm, hail, tornadoes, hurricanes, ice storms. So the risk of other things that may damage our house is a little bit different, right? So every state, you go from state to state, it's going to be different, right?
Yeah.
And so going back to investing in real estate, it's good to invest in real estate too, but you got to know the risk. I mean, if your insurance costs and taxes and everything is going up 25%, that's really going to make you rethink how you have to do your investments, right?
True.
Especially those that are already in the market, already doing investments on their current properties, and now have to see an increase in that. Like, how do you explain to your tenants you have to increase everything by 25%, right? Excuse me. Another way that people invest their money is investing in themselves. Their own business, right? Business owners, business entrepreneurs. Person like my wife, Twin-Yum, I don't think she's watching right now because she's in Korea right now, so I hope you're having a good trip, honey. But my wife tells me, I don't know nothing about real estate. I don't know nothing about stock market. I don't know anything much about insurance except for what you tell me. But I believe in my own company, right? So I have my own stock that I can buy, and I can make my own money. And I think my stock going up pretty good. So you don't need to invest in the stock market. Like I see you guys invest in the stock market, and people losing their money. I don't lose money here, right? And I'm making jobs, and I'm creating jobs for people. So I believe in investing in my own business. So there's many ways like where people are investing their money, and there's no wrong way per se of how to invest your money, but you just have to understand the pros, the cons, the risk involved, and so that is it an appropriate risk for you to invest your money in? Because investing means that there is risk, right? There's no investing with no risk unless you have no risk. That means that you have very little potential for gain.
Exactly.
Right? And so many different ways to invest their money. Anybody here that's investing right now in our audience, maybe you can share what you're investing in right now. You don't have to say how much money, but you can just state what it is. I know if Auntie Julie's here, she's probably going to say cryptocurrency because she loves cryptocurrency, and cryptocurrency recently has had a crazy train. Right, we started out the year, it went up like 60%,
Yes.
and then it took a nosedive, and now it's back down to where it was the beginning of the year. It's been kind of a crazy roller coaster. What do you think about that, Alex?
Well, crypto right now, there's a lot of things, there's always news being put out. They call it FUD. FUD is kind of like negative information. So news, people follow the news, they see it, they get scared. Retail investors will buy in when just general public will sell during those times. So it's a rough game, and cryptocurrency has it has some potential use right now. There's some tokens and coins that do have use cases, but it's more of a speculative thing right now. I don't think the world is ready for it. So technically, if things don't have a use case, then people don't have true faith in it. So you're pretty much gambling on the odds that in the future there will be more people that believe in it and more use cases of it, but it's really subjective right now. So if you're holding right now, I would just say, you either choose to hold your position and wait, or consolidate and move it somewhere else. But that's solely up to you. Everybody has their own strategy. As Jonathan said, every type of investment is good, but everybody has their own situation, their own how much their own budget is, and their own skills, like set of skills. So you have to assess yourself. What's good for you? What are you good at? What do you understand? What works for you? So just because something may work for Frank might not work for me. Just because something works for me might not work for Jonathan. So just because your friend said he's doing great in this, you shouldn't copy him and do what he's doing, because his level of skill or his understanding of that industry may be different than yours. So as Jonathan said, you got to dig deep and understand what are you good at, what works for you, how is your budget, and figure out your own gameplay. So always try to understand about yourself, focusing on what you're good at, what you want, and go towards that direction. So cryptocurrency, if you're cloud chasing and trying to go to the moon, it's up to you, but you got to understand when to play, when not to play. So it's it's just like anything else.
Cryptocurrency is a relatively newer market of investing. People hear a lot about it. We'll touch a little bit on that, but it's unlike traditional stocks and investments where they derive the price of the stock based on the financials of the company, right? But even so now, with COVID happening and all, a lot of the pricing for certain companies are not, equivalent to what they're actually making, right? It's more by hype and by memes and things like that. So the way people invest their money is very different right now, and it's going to be interesting to see where things are going to be going, in the near future here. Especially now, I'm starting to see with inflation raising up, people are concerned about their money value, and they're thinking about moving it to different places, but people really don't know where to move their money, right? And so some people may think that, hey, you know what, I made some money here, and I'm going to take my money out of here, and I'm going to see where the next good place is going to be. So that when people take their money out, you're going to see the market go down for that particular industry, right? You know, real estate's going up right now because maybe people made a ton of money on stocks last 2 years, and now they're taking money out and they're moving it to a fixed asset, right? That hopefully can generate them a consistent income. That's what they're banking on. You know, people that made a ton of money in cryptocurrency, you know, they went up 1,000%. You know, they're trying to pull their money out now slowly so that they can reposition somewhere else because they feel that maybe another investment is a more viable investment at this time. And so it goes back to diversifying too, right? It's not wrong that you want to take your money out after you made money, but then now other people may be losing money, but it's just all part of the game, right? And where your timing is when you came in. But over the long term, hopefully, you know, things improve if you got in at the wrong time. But it's all about rebalancing and looking at your budget. So that's why what Alex said is true. You got to make sure that when you are, you know, investing your money, that you re-look at what you're doing, you know, on a quarterly basis at least, or at least an annual basis at longest, and see like, hey, how are your investments doing? Do they still align with the goals that you've been working with? And do you need to make adjustments to that? So that way you're not too far into one type of investment, that you reallocate things and you balance it out, right? So, so let's go into our three primary topics today. Since I don't have a real estate expert today, and I do hear that some of my friends are interested in coming on show with me, so I will go offline if you guys are watching this show right now, or you see this show and you would like to be a guest speaker on our show. Nuggets of knowledge to our audiences, you know, we welcome you. Just hit me up after offline or message me, and you know, we can work out something where we can sit down together and you can share with us, you know, your career, your story, and a little bit of information that you want to share with our community. And you know, that would be fun. So I'm opening that up to other professionals that, you know, if you are, you know, in a professional field of some sort, and you want to kind of share what you do and what you're passionate about, you know, let me know and I'll be happy to bring you on stream, and you know, we can sit and talk and get to know each other a little bit more. Okay. But for now, so let's talk about the stock market first, right? Because we don't have to talk too much about the bank, right? The bank is the bank. It's pretty boring, right? So, so Alex, since you know, you are guru for the stock market, you know, without going in too deep, can you help us, the audience, understand like a few key terminologies when they're investing into the stock market that they need to know, so that they kind of understand what that means? Because there's some things like, you know, dividends and stocks, bonds, mutual funds, ETFs. What do these things mean, right?
Okay.
And so if you can give us like a high level what it means, that way the audience can better understand that if they choose to go the stock market route, where, you know, a lot of people are making money in there, or maybe the stock market's down right now and they think, hey, maybe a good time to buy in. You know, what should they know about some key things before they make an investment?
Okay, well, let's start off with the stock market. As we know, there's some simple terms. There's something called a bull market, where things are looking good. You got sunny days, prices are going up, everybody's making money, and you got something called a bear market. A bear market is when things are looking down and things are looking low. So there's a couple different type of traders. There's short-term traders and long-term traders, and there's swing traders. So a short-term trader, what they're trying to do is they're trying to buy in on a stock when it's low, and then they're trying to make a real quick profit and flip it and see their gains real quick. You know, some other traders, what they do is they'll buy a stock. They really believe in the company. They're into the fundamentals of the company. So they'll buy and they'll hold. And usually when you buy and you hold, in the long term, you will win. You know, if you look on an average of most stocks, you look at its yearly gains, like Apple, Amazon, etc. These things over the year, if you look at the chart, it's exponentially going up very well. A lot of good companies that have good fundamentals, that have a lot of good use case, that have been growing, tech companies, they over time, you're gonna win. But if you're a day trader and you're trying to buy low and buy high, or weekly trade, and you might actually lose. So sometimes when you're trading, it's better in your best interest sometimes to just buy and hold, because in the long term you will win. You know, it's more beneficial like that. So say for example, now we're in a bear market. You don't know how to trade. You're not very skilled at looking at charts. You're not really good at looking at balance sheets. You don't understand how to read the fundamentals. There's a couple other ways to invest and make money in a very, I guess in a more sense where it's easier for you and it's less threatening. So I'll talk about one kind. One kind is called a dividend. So a dividend is like when you can buy a desired amount of a dividend, okay? And what you can do with the dividend is when you buy it, every single time the company gets its earnings, either quarterly or yearly, they will give you an X amount, okay? So I'll give you an example. Say you bought 1,000 shares of a certain stock and it was trading at $100, okay? So the dividend would give on average maybe 1.7% to 3% a year. So if you put in 1,000 shares, you would make $3 per share, and that would be about $3,000 a year. So this type of investing, you would just diversify with different companies that you like, and you would just wait for the annual gains or the quarterly gains and gain the money like that. So dividends are less aggressive. You don't really have to worry about when to buy and then when to sell it. You kind of just buy it, and then once you get your gains from the dividend, you can do two things. You can reinvest the dividend back in, or you can take the gains out. So that's one simple way if you're not too scared or if you're too worried about buying and selling a stock and not knowing how to time that.
Basically what you're saying is, Alex, is that a conservative way for you to invest is that you buy a stock of a company that is a very long-standing, stable company, and they have a history of paying dividends every year.
Yes.
And then you wait for that dividend, like the money you make on the stock moving price is not going to be much, but then they're always going to pay out a dividend every year.
Correct.
Well, not always. The dividend, remember, ladies and gentlemen, is not guaranteed. So a dividend means that if the company has a profit and they want to give you some money back, they're going to give you some money, right? But they're not required to give you a dividend. So if you're buying this, but traditionally when you want to look up, you can look it up online, like best dividend paying companies, and you can look at that, and then it'll give you a price of how much that stock of that company is, and you can buy that, and that every time the dividend pays out, like on a quarterly basis, you're going to receive a check, or like Alex said, you can reinvest it, right? Great. So so that's one way of buying stocks, is looking for good dividend paying companies.
Yes.
Okay. What about, like, say, Alex, if I hear a lot about bonds, right? Can you explain about the bonds?
Okay, so say you're confused now. Dividend, oh, that sounds too much for me. I don't know how to choose it. I don't know how to select it. I want to do something that's more stress-free and not really much of a full guarantee, but something where you don't really have to use a lot of strategy. There's something called treasury bonds. So treasury bonds are short-term government debts that are backed by the U.S. Treasury. So say, for example, a construction company or school, they need funding, the government will give them a certain funding for that. So once these things, they usually last, the maturity date of these usually lasts from 4 weeks to 52 weeks. So what happens is that you would buy a bond at a discount. So say, for example, the bond is $100, okay, a bond, you would get to buy it for like $95. So by the time it hits the maturity date, it's guaranteed to be probably at its $100. So that means that you would make the difference. But if that bond would overperform, you would make more out of it. So these are considered more safe and conservative investments because they are backed by the US government. So it's something that you don't have to feel like, oh, I'm going to put my money in there and then I'm going to lose everything. So it's, the gains are not very high, but like Jonathan said, it's about risk assessment. If the more riskier it is, the higher chance of you losing things. So with the bonds, it's very low payout, but the ability for you to actually win is a lot easier. So some people who are worried or scared of picking an investment that's risky, treasury bonds could be something of your liking.
Okay. So it sounds like a bond is like basically like a debt, like a loan, right?
Yeah.
Okay, and you're investing in that loan.
Correct.
Okay. So, ladies and gentlemen, so it sounds like what Alex said is that the government is always lending money out, right? But then when they're lending money out, rather than using their own money, they want us to help them lend money out. So they're asking us, hey, you want to invest in this loan or this bond that for this particular project, and it's going to mature at a certain date, so they're going to pay you a certain interest rate, or they're going to pay you the face amount of the bond that you bought on discount. Say you bought it for $80, and then at maturity it's $100. So if everything went well, you could make $20 of interest, right? At the end of the bond. But if it overperformed, maybe there's excess money that's invested into the program, then they may pay you out a little bit more, right? Or if it's underperforming, maybe they didn't get enough investment, then when you mature, they may not give you the full 100, then maybe they give you 90, you only made $10, right? Something like that.
So keep in mind too that just because you buy the bond, you don't have to wait until the complete maturity date to sell it. You could sell it earlier if you like. So say if it was overperforming and you want to get rid of it to get the gains, so you can go and reinvest somewhere else, you could do that too. So you don't have to wait for the full maturity date before selling the bond.
So the safest are the treasury bonds from the government,
Yes.
but then corporations also have bonds themselves that they're raising money for certain projects too, right?
Correct.
So corporate bonds, are from companies just like say Apple or whatnot. They're trying to fund a big project and they're looking for investor money. They could issue their own corporate bonds as well, but those carry higher risk. They're not backed by the government, right? So those are bonds. So it sounds like bonds and stocks, Alex, is kind of like individual companies, right?
Yes.
So I hear a lot of people talking about mutual funds, like where there's like a bundle. Can you explain what mutual funds are?
Okay, so mutual funds are kind of in the middle between the stocks, the dividends, and the treasury bonds. So the mutual funds, they are very easy to access. It doesn't really require you to understand balance sheets, reading charts, understanding the flow of the market. The reason being is that the mutual funds are an investment pool where you purchase kind of like a basket of things. And what I mean is that imagine you have a suitcase or a basket and it has a bunch of different stocks, maybe from the top 5, like say the S&P 500, top 500 companies. What they do is that you'll have a fund manager, which is a specialist, will selectively choose high-performing stocks for you and diversify it for you. So say, for an example, if something is not performing well, if you don't want to put all your eggs in the basket, because what if that one fails you, right? So when they diversify for you, the chances of that happening, you have different stocks that are balancing out your portfolio, hence giving you more potential for you to find your gains. So like I said, these activities are managed by a fund manager. You can select from biggest stocks in the United States. You can also pick from the biggest and the smallest. You can pick from China. You can pick from South America, and or you can even pick from income from real estate, where you don't have to directly buy the property too. So it's not too bad. The average yield has been showing about in the past 20 years about 4 to 5%. So if you're not into big on trading stocks and trying to pull that 10% in a month, and you just want to have your money sitting there and you don't want to have to manage it yourself, you can do a mutual fund and have a specialist take care of that for you. And in the longer term, you can see more consistent gains for yourself.
Okay, so mutual fund sounds like everybody is that when you go buy stocks, you can either buy one stock of a company, say like Coca-Cola or Apple, right? Or you can buy a bond with the government. But that's only one, right? So what happens if this one company goes out of business? You lost all your money, right? Or what if the government decides to like have something like COVID happen and shut down? Now you lost your money, right? So when you buy a mutual fund, from what Alex says, it sounds like it's a bundled together of different companies and stocks, so that you have more companies all in one. So that say if one company goes bad, you still have the other ones that are still up. So it kind of makes up for that. At the same time, for you to buy one stock of Apple right now, how much is it?
Probably about Apple stock.
How much is Apple stock today, Frank?
I haven't looked at it in a minute.
120 to 130.
Yeah.
It's been around that range.
Apple stock today actually is at $146.39. So if you wanted to buy Apple stock today, do you have $146 in your pocket to buy it? Maybe not, right? And there's only one stock. Now, if you buy a mutual fund, you could buy, say, a tech mutual fund that has Apple and amongst many other tech companies in there, and maybe that particular thing is only like $50, right? But you get a little piece of every company, you know, in there rather than just one, right? But of course, there's fees involved. And so you have to understand that, hey, some mutual funds have fees and costs. So you have to research that to make sure that's appropriate for you. But like Alex said, you know, give yourself some more diversification. If you really don't know what you're doing, you don't know what company to buy, mutual funds are another way, a great way to diversify your portfolio and be able to have many different choices all in one. And if you say, hey, you know what? I just believe in industries, right? I know transportation is going to come back. I know travel is going to come back. I know tech's going to do well. Real estate right now is doing awesome, but I don't have $100,000, $150,000 to go buy a house. Well, you can invest in mutual funds that are in those particular markets that you believe in, and that if you think it's going to grow, you can buy those mutual funds and you can experience some growth or some losses depending on how the industry is doing, and you can, you know, invest that way as well. And mutual funds are, you know, been used most of America's money are in mutual funds, right? 401k plans are in mutual funds. And so mutual funds is just not the new kid on the block. ETFs not thing new on the block. They've been around for a long time, right? You have one more thing, right,
yeah,
Alex?
I have one more to share. So this one's it's been around forever, you know, and nowadays there's actually a different way to invest in it. It's precious metals. So as you know, precious metals is like gold, silver, platinum, etc. These are decent ways to diversify your portfolio to hedge against inflation, you know, because the thing with precious metals are once they are on the earth, you cannot reproduce more. They're gonna that's it, you know. So that's always gonna go up, because if gold disappears, or they're not going to reproduce it anymore. So as time goes over, it's going to become more expensive. You know, holding gold or holding precious materials could be kind of annoying, because you have to put it into a storage, or you have to put it in your house. Where are you going to put it? So nowadays, with technology being so amazing, you can actually buy ETFs of the gold. So you're pretty much investing in the precious metals, but you don't have to hold it in a bank, in a storage, or in a vault. So it's actually a decent way, like I said, to hedge against inflation. So you can own the commodity without actually holding it, which is great. So I actually have a couple friends that live in Thailand, and they like to trade gold and silver, and they just do it through ETFs. You know.
Okay. Yeah, my wife, she loves gold. And she told me that, you know, I don't want to invest my money in the stock market or whatever, but I will buy gold. If it's anything besides my own company, I will buy gold. I want that 999 gold, that little gold pallet thingy.
Mm-hmm.
You know, we got one for a couple for our wedding, and I don't know where she put it. She has it, but she's hiding it somewhere. But that's another problem, right? Mm-hmm. What if you hide it and you don't know where you hide it and you lost it, right? You know, that's a problem. Mm-hmm. And so, but reverse back, some people say, hey, at least I can touch my gold bar, right? Yeah. At least I can smell and lick my gold bar, and I know it's real. But if I put it into the stock market or like an ETF, like Alex says, it's just there. It could disappear, right? It's just a number in electronic space. So, but precious metals, Alex, yes, people like to touch and feel what they have. That's why people love real estate, because I can see, touch, and I know it's there, yeah. Right? So precious metals, another very popular way people invest their money. You know, I know my wife loves investing in gold, and she keeps telling me, hey, let me get $50,000 of gold. I'm like, man, where are you going to keep that $50,000 in gold? But we'll see. Well, I have a guard dog in my house. I'll let Dory guard it for me. Okay, so thank you, Alex, very much for preparing that material on the stock market. I think that's a very smart way to kind of like educate our audience that, you know, not trying to tell them what specific stock to invest in, but just basic concepts of, hey, what type is out there, so that they can broadly search, hey, what's the best dividend paying company right now, right? Mm-hmm. And then they can choose, right? Or, hey, what's the best type of treasury yields right now that are offering, and they can look it up. And the government has the whole website that shows you all the treasury yields. And then mutual funds. There are thousands of mutual funds out there. And if you think that you believe in a particular industry, but you don't have enough money to buy that stock or bond, mutual funds might be the way too, right? And then in those of you who like to touch their silver and gold, then touch your silver and gold. But let's move on to our next topic here. Frank today has prepared some material. Because Frank right now, he loves life insurance. He loves health insurance and life insurance, and he totally believes in it because why? He personally, in his own family, himself, experienced using health insurance, and it's changed his life. And also, there's some life insurance that was paid out to his family members and him, and that able to give them peace of mind in a time of uncertainty. And so he really believes it, even though he's very young. Unfortunately, some things that happen that we have to experience these things at a young age. But because of that, Frank is very passionate about life insurance and health insurance. And today, he's been learning more about life insurance. Not only is there a benefit when you pass away, you get sick, but he also knows that if you structure it right, that life insurance could be an additional tool that you could use to invest your money into if you do it the right way, where it can give you some great tax advantages. So Frank, maybe if you can help us explain a little bit more about how that works. I think a lot of people have invested into a lot of different places, right? The stock market, the real estate, crypto, gold, but I don't think a lot of people thinking about investing in life insurance.
Yes,
so
they
can
don't.
you explain to them how that works?
Okay, sure. Thank you, Jonathan and Alex. So first of all, when we talk about life insurance, what the people think about is pure protection. They think about the pay that they're going to receive after they pass away. They don't think about life insurance as a tool of investment, but it actually is. Traditionally, yes, life insurance is for protection only, but because we've been progressing so far now, life insurance actually has so many forms on the market today. And life insurance, what I want to talk about today is you can actually invest in life insurance as an investment if you know how to structure it correctly. So that when they grow, you could have some cash value, which is tax advantage to you and your family. So when you retire, you have an additional stream of income to use besides your 401k, your Social Security. Because sometimes they might not just be enough.
Right.
So now if you have an additional stream of income, you have more flexibility to spend, live a life of longevity and wealth. So that's what we're aiming for, right?
Multiple streams of income. I like the sound
Yes.
of that.
So, they talk about investing. Now I want to talk about people who like to save, right? We talk about savings. For people who are very conservative on savings, and they always try a different type of ways to max out their savings, like putting money into, the IRA, Roth IRA, 401k, even the health savings account and the 529 plan. They max out everything. Now, when you come to me and you ask me, hey, I'm maxed out on my savings on everywhere that I possibly think of, where else could I put my savings in? So my answer is actually simple. You can put your savings, the remaining of your savings, into a life insurance policy.
Right.
Because life insurance can help you save money where if you do it right, it can be tax-free to you. The purpose of this type of life insurance policy is that you still have some money for protection in the worst case scenario, but primarily is going to grow some cash value on the long term.
Okay.
So you can have, like Jonathan said, additional stream of income. But like I said, the primary goal, because the primary goal of this type of life insurance is to accumulate more money into the policy tax deferred. You can also access the cash value in the policy as a type of a loan. So you don't necessarily need to withdraw the interest, because if you loan out the interest, then you trigger a taxable event.
Got it.
But what you can do is that you can loan against the policy, and that does not trigger a taxable event. So that's something you want to keep in mind.
Okay. Do I pay interest though when I take a loan out?
You do have an interest rate for every company that you buy with. You can either pay back the interest rate, or when you pass away, they can deduct the amount that you loan out plus the interest rate, and then your family gets the remaining amount.
So it sounds like I can invest my money, but I have to pay to borrow my own money. Is there programs out there where I don't have to pay interest rate?
The a program out there where you don't have to pay the interest rate, not to my knowledge right now. So far, all the yeah, this is
Okay. So it sounds like you can you borrow, but if you borrow it, you don't have to pay it back, but
You
you
don't have
just
to pay it
deduct it from your death benefit.
they would deduct it.
Okay. Okay.
So just give me 1 second. I have one example to show the viewers, just so you know more details, right? What if you're a 40-year-old male and you buy a policy where you pay $1,000 a month? The death benefit is only $200,000. It's not a lot, but like I said, because the primary goal of this type of insurance is you want to put the most of your money into growing in the long term. So let's go over the example. So if you pay $1,000 a month, you actually put in $12,000 a year, and now you're 40, but by the time you're 65, you would have put in about $300,000. But assuming that the annual percentage rate is 6%, you actually get $550,000 back. So it's quite a lot of money. And from 66 to 80, you can actually withdraw $51,000 a year. So it's about $4,000 a month.
Wow.
So that's still a lot, on top of your Social Security and your 401k. So you actually might live a good life. But that is assuming the 6% interest. What if you can do more than 6? What if you can do 7 or 8? Well, if you can do 7, you can actually take out about $64,000 a year.
Wow.
And if you haven't the 8%, you can actually take out about $80,000 a year. So that's how life insurance as an investment cycle works. You can actually grow your money and you live a good life, and because you have an additional stream of income.
Okay. So it sounds like traditionally, like Frank said, do you have anything else to add, Frank?
I think that's it for me now.
Okay. So it sounds like from what Frank said, it sounds very interesting, right? Using life insurance as a form of investment is not something most people really think about. So what you're saying is very interesting. So it sounds like you buy life insurance, so in case something happens to you, you have life insurance. But if you don't need life insurance later on, say like, why we buy life insurance, everybody, is because you have responsibilities that you have to take care of, right? And you're worried that maybe you have debts to pay off. If you pass away, you don't want to leave it to your family. Or maybe you have very young children that need to go to school. Or maybe you have parents that you want to make sure that they're taken care of if something happens to you, right? So you have these responsibilities, people that you care about, you love, and you want to make sure that they're taken care of in the case that you are not here. And so that's what primary life insurance is for. But a lot of times, the need for life insurance goes down or goes away as we get older because our children may grow up already, our parents may move on to the next life, our kids don't need to go to school anymore, we paid off our mortgage, like what do we need life insurance for anymore, right? Other than the fact that we want to leave some money behind for our family, but the need for real life insurance is not there anymore. So you want to be able to convert your savings or the money that you put into your life insurance to put it to use for something else. Is that correct, Frank?
Yes.
Is that what I'm hearing?
Yes.
And so, but it sounds like, $200,000 and you're paying $1,000 a month, that's kind of, when you think about insurance, that's kind of expensive, right?
It is.
But realistically, the cost for that insurance doesn't really cost that much. Maybe like $200?
I think so.
Something like
Really
that,
good term.
right? So if the cost isn't that much, that means the extra $800 you putting into there is actually going into your savings, right?
Right.
Because you're trying to accelerate this thing. You're not trying to say, hey, you know what? I want $500,000 by the time I'm retired in 20 years, and I'm going to save $50 a month. It's not going to happen, right? Even if you put into the stock market and you buy a option for $50, it's still not going to make you that much money, right? No way, unless you got lucky with like crypto where you bought it for, a tenth of a penny and you put $50 in, and you maybe you make $50,000, but if you're lucky, right? But the chances of that happening is like winning the lottery, right? You don't know.
Yeah.
So, when you're thinking about saving or investing, what you put out is what you're going to get back, right? So if you put out a lot, you're going to get back a lot. Why? Because there's more money to work with, right? Just like if you say you're making a hamburger or a meal, right? If you put out a tiny little piece of meat, how big your hamburger going to be? Not that big, right? But if you got a nice piece of meat, you're going to have a nice big hamburger. So just think of it when you're investing your money. When you're using life insurance, don't let that $1,000 a month or $500 a month scare you. Ask the question, how much of my $500 is going into my cash value savings so that my money is going to work for me? Right? That's the question you need to ask your agent. When I put this money in there, how much of my money is actually going into the investment so that it's really growing? Right? Now, of course, we don't know what the interest rate is going to be or the interest rate we're going to earn is going to be. It's all hypotheticals, right? So they're guesstimating what you're going to earn, 6%, 7%, 8%. Of course, you want to be very conservative. If somebody's promising you 10, 12%, you better run away from that person, right? But if they're just conservatively telling you, at least you have an idea of what you may have by the time you retire. And if you fund it right, you can have that stream of income, right? I think to expand more on the interest rate portion, Frank, you're right. Majority of companies out there right now, everybody, they charge you an interest rate, right? There's a lot of companies out there charge you 6 to 8% interest to borrow your own money. But people may think, hey, you don't need to pay it back. Some companies make you pay it back, right? Some companies don't make you pay it back. But you have to make sure that you have enough cash value in there so that you can borrow against it. But remember, borrowing against your policy, if too early, it could mess up your policy too, right? So you don't want to just be taking loans all the time out of the blue. But if you really have an emergency, you can loan against it. But if you do it right, the way Frank says, where you're just putting the money in now right now, you close your eyes, you're saving your money. And when you get to retirement and you start taking those money out, they're going to return your premium that you put in first. Right? So when you get that money back, because it's your own money, you don't pay no tax advantage. Two is all the interest earning in your life insurance is tax deferred, like Frank said earlier, meaning that you don't need to pay the tax every year you make the money. Right? You're pushing it back till later when you take it out. So like Frank said, if you take out the interest though, you withdraw, you will incur a taxable event, meaning that you must pay taxes on the interest portion that you're taking out. But the insurance companies, they're smart. They think of this very creative way where they say, hey, you know what? We're going to loan you the money instead. And because we're loaning you the money, instead of paying the taxes, now what if your tax is 20%, but you're borrowing for 6%, then they're saying, hey, you're still benefiting because even though you're borrowing for 6, 7%, your tax is going to be like 20%, 15%, right? So you're still making money, right? So then essentially they're telling you that, hey, you're still benefiting, right? So when you take that money out as a loan, you are not paying the taxes on it because you're loaning it out. Now, there are some programs out there, ladies and gentlemen, that when you borrow from your life insurance policy and you've held that policy long enough that when you borrow against it, it could be a lower interest rate. They give you a discount on the interest rate, or it could be where they charge you an interest rate, but they credit you back the interest rate to your account, so it kind of washes itself out, right? So, talk to your agent, talk to your advisor. What kind of program do you have, right? Do you have an old program? Do you even know what you have? Could your program be a investment type life insurance? Or could it not, right? But if you're not sure, give us a call or come and check us out and let us know what you have, and we'd be happy to do you a free review, a complimentary review. But life insurance, as you can see, Frank says, it's like creating your own pension, your own Social Security. You put the money in now to protect your family, but if you put in a right amount of enough money, like extra money into that policy for it to grow, potentially you can start taking that out as an income, and it could be more than what you put into it, right? So life insurance as an investment, I think we have videos on that too, right?
Yes, we do.
If you guys check that out, we have one in English that I did myself, And then I also have another video that Frank did in Vietnamese. You did it in Vietnamese,
I
right?
did with Alex.
Yeah,
Yeah.
we did it together.
Yeah,
as a
so Alex and Frank did the Vietnamese version of that. So for those of you who want to look at it in Vietnamese, we do have English and Vietnamese right now. For those of you who want other languages and you can contribute, please contact me. I'd love to be able to work with you to create other languages like in Spanish or in other languages because we want to be able to touch more people and be able to help other people as well. So thank you, Frank, very much for sharing on how to invest in life insurance. The last topic I want to share with, and I think we're a little bit over time right now, but it's, we haven't talked for a while. So the last thing I want to talk about is investing in like insurance annuities, right? A lot of people think that annuities are for old people. Some people don't believe in annuities because like, oh, I don't want to hold a contract. I think I could make more money in the market than an annuity can. Yes, the annuity is not made to try to beat the market. The annuity is there to give you some peace of mind, some guarantees that you don't have to worry. You have more peace of mind when you're investing your money. Now, annuities is like a chassis. It's like a type of account, like an IRA, whatever. But within an annuity, an IRA account can be an annuity, a savings account can be an annuity, a general investing account can be an annuity, but within the annuity you can invest it in 3 different ways. Okay? The first way is there's a fixed annuity. A fixed annuity means that it is a fixed interest rate. So basically you give your money to the insurance company, and it's much like a CD at the bank, which is called a certificate of deposit. They guarantee you an interest rate and you hold it for X number of months, years, and they're gonna give you a certain interest rate. The fixed annuity is gonna do the same thing, but the interest rate may be a little higher, but you have to hold a contract with them X number of years. The longer you hold it, the more interest it's gonna pay for you, right? But it's still fixed, it's still gonna be very low because remember, low risk, low interest, right? Low gains. The second way you can invest in an annuity is through an index type of annuity. It also is a fixed type product, but what's so special about an index? An index annuity follows the indices, S&P 500, whatever indices out there that you're trying to follow, and then they will credit you the interest on an annual basis, 2-year basis, depending on the strategy that you pick. But in a nutshell, the index annuity will protect you on the downside where they'll guarantee your principal, meaning that you don't lose no money, right? But then they'll cap you on your interest that you could earn. So say if the interest rate for the S&P was 10% that year and their cap was 8%, then you're going to only make 8%. You can't get 10. But on the downside, if the market was negative 10%, they will tell you, hey, you didn't lose any money at all. So putting your money into an index annuity may give you some gains, a little more conservative, but the worst case scenario, you may make nothing, right? But you lock up your money into that product. It could be a 6-year, 7-year, 8-year, whatever year contract the insurance companies require. The last type of annuity is a variable annuity, or sometimes they have even index variable annuities. That have certain strategies, but basically a variable, when you hear the word variable, it means that it's invested in the market or in sub-accounts that are tied to the market, and then you could have losses, you could have gains. But the nice thing about the variable annuities is sometimes they may attach on like the index variable that may give you some form of guarantee, right? So for example, very popular now in recent months or recent year, the index variable annuity allows you to have best of both worlds on the variable annuity and the index annuity, where they provide you a guarantee where if the company says that, hey, if the stock market dropped down, 20%, and they give you a 20% protection buffer, they will take that loss for you up to 20%. Right? If say the market lost 14, but you have a 20% protection, that means you lost 0, right? Because you are under the 20% loss. If you have a 24% loss in the market and you have a 20% buffer, then you only lost 4% because you have a 20% protection. Pretty nice, right? There are some companies out there that they may give you, just say, a 10% buffer, but if you stay within the 10% buffer or higher, they'll still give you a positive interest rate gain, right? So there's many different guarantees that they give you, but you gotta ask the question like, okay, hey, are you willing to trade off some of the gains so that you can do this program? Now, some of the programs even let you have an uncapped gain too, right? So you can gain as much as you want. The only thing that they ask you to do is they hold your money for X number of years, right? They still have that contracting going that make you hold the money for X number of years so that they can make their money on the back end. Some programs offer no fee too. No fee, meaning that if you invest your money in the market, you have to pay a fee to your advisor, right? Now there's trading now that we don't have to pay fees on stocks, which is great. But some of these annuities, they don't have any fees. Now, some people may tell me, John, that's not true. I see like my annuity charges me 1%, 1.25, 1.5%. It's because you're adding on some form of rider, right? And the rider, what are those riders? You got to ask yourself your question, two things. When you do an annuity, you have to make a decision. Am I doing this for growth? Or am I doing this for income? And what do I mean for income? Think of Social Security. Think of what Frank said about the life insurance. When I retire, I want a fixed income coming to my as a paycheck into my bank account every month, right? And so we can do the same thing with annuities. But if you choose to do an income annuity, the growth from an income annuity may not be as much as the pure growth annuity, because now you have to add on that feature. When you add on that feature, there's a cost, right? So when there's a cost, that means that you may not make as much interest, because now you have to pay a cost to guarantee this income, guaranteed income. And what do you mean by guaranteed income? Is that when you retire, when you're ready to take income from that annuity, that money is going to come to you every month for the rest of your life, even when that money in that account goes to zero, meaning you took all the money out already, right? And now there's no more money in that account, but they're still going to pay you a check every month, right? And that's the nice thing about annuities. Now, if you pass away before the annuity runs out, then whatever balance is in your account goes to your family. When you go with Social Security, you give them your money. If you pass away, that's it. They're not going to give your family the cash in that account, right? They keep everything. So, those are annuities. To sum that up, many different ways that we can invest our money. Remember, there's the savings account at the bank. We got the stock market. We have precious metals. We have cryptocurrency. We have life insurance. There's real estate. There's business. And then we have insurance products like annuities as well, right? So I hope you guys learned a lot today. It's been about an hour and 20 minutes. And so we're going to come to a close. I thank you guys so much for joining us. Thank you for those of you who are stay with us the whole stream and supporting us. Remember, our show goes every Friday from about 1 or 2 o'clock in the afternoon. And we'll replay this throughout the weekend. And then on Monday, we do our show in Vietnamese as well. And so another thing is that please follow our Facebook page so that you can get the updates. Also follow us on YouTube for our pre-recorded content that we come out. We have a very professional team that does all the video recording, the back end stuff. And Beth, thank you very much for doing all our stuff for us. Yeah, I wish you guys a wonderful weekend. Thanks again for joining us for the PARAMIC Hour. And we're out. So I'll see you guys next time. Alex, you have anything to say?
That's it. I'm happy to be back. It's been a little bit while since I've been on the live stream, but it's nice to be able to share with you guys my thoughts and changes that I've been going through and different strategies that we use to prepare ourselves to invest. Like we said before, everybody has their own way of investing. Definitely find what's suitable to you. Do some research, see what you like, and maybe give it a shot. And if you have any questions, you always can check out the internet or talk to us and just get some basic ideas or better understanding of how certain things work.
Awesome. Frank, you have anything to say to the audience?
Just want to say thank you everyone for joining us today. I know it is a lot of information, but like Jonathan said, we're going to keep replaying this over and over again. And then if you have any additional question, you want explanation in a more personal way, feel free to give us a call or text the office, and we do our best to assist you.
Okay. And before we end our live stream today, guys, one thing I want to say is I want to congratulate Frank. He's done a wonderful job in the last couple months, and our firm has decided to promote him to the next level of associate. So Frank, congratulations on your promotion to an associate. You really truly believe in what you do for our clients, for your family, your community, and I really appreciate that. It's been a long time where I run into another person who's passionate about helping people like myself and Alex, and so I really appreciate you. I'm glad to have you on our team, and congratulations on your promotion.
Thank you.
Right?
Thank
You
you.
get to make more
Appreciate
money
it.
now, and
Help
yeah.
more families.
Yeah, help more families, and keep an eye out for. We're gonna do a new thing now. We're calling it TGIF. Thank God it's Friday, but for us, it's thank God it's in force. In force means that we place a policy in force for a family,
Yes.
in that we help protect their family. We help do some financial planning for their family.
Yes.
So we're gonna be sharing that on a weekly basis now. The families that we have helped. And whether it's big or small, we won't name any names, but we just want to share with you guys to let you guys know that we're very passionate about helping families. And if you guys know any friends or family that do need help with anything related to finance, please refer them to us, or please let them know that they can contact us at any time. And we are here to help and educate you guys, and do the best we can to help you. So congrats again, Frank.
Thank
Really
you.
proud of you, bro.
Thank you.
And thank you very much. Okay, so everybody have a wonderful weekend. Bye-bye.
Bye, guys.